look at the gross profit method. This is a useful tool in accounting that we can apply when we have to determine an estimated ending inventory. It is used in cases where we need to determine the value of inventory that is no longer available to be counted, such as in the case of a fire, flood, or theft. We could also use it for interim financial reporting. Remember, in the periodic inventory method, to determine the cost of goods sold, we have to count ending inventory, which is time-consuming and expensive. For interim financial reporting, GAAP allows the use of the gross profit method. So we will estimate ending inventory and use it to determine cost of goods sold. The estimated inventory will go on the balance sheet, cost of goods sold on the income statement. Auditors use this method to test the reasonableness of the inventory amount being reported on the client's financial statements. Managerial accountants will use the gross profit method in establishing budgets and forecasts. The method is based on the periodic inventory formula, where beginning inventory plus net purchases gives you the goods available for sale. You can then take a physical count of the inventory and apply FIFO, LIFO, weighted average to come up with the measurement of ending inventory. The value of ending inventory would then be subtracted from the goods available for sale to give you the cost of goods sold for the period. Remember, in the periodic method, cost of goods sold is an adjusting journal entry. Well, we can take the following data and we can estimate the cost of goods sold. We can then inject this into our formula to estimate ending inventory. The pieces of data we're going to need is the beginning inventory, the purchases, and an historic gross profit percentage. Remember, the gross profit percentage is gross profit divided by sales. When we have estimated gross profit, we can manipulate our inventory formula. We can build it by taking beginning inventory, which can be taken from accounting records. If these are not available, we can go to financial reports such as audited financial statements, tax records, insurance, underwriting claim forms, and we would establish a beginning inventory. We would then add in net purchases, which again would come from the accounting records. We can reconstruct these from third-party sources. Adding the beginning inventory plus the purchases gives us the cost of goods available for sale. We'll then take our estimated cost of goods sold, subtract that from the goods available for sale to come up with the estimated inventory value. Developing the historic gross profit margin is the key to applying this method. Large companies and small in the manufacturing and retail businesses carefully manage their gross profit. Let's take a look at this using Home Depot. Over the past 4 reporting periods, Home Depot has had a declining revenue. It went from $77 billion in 2008 down to $66 billion in 2010 before making a slight recovery in 2011. But notice, despite the decline in revenue, Home Depot has managed to maintain a steady gross profit margin of 34%. Using this historical information, we can generate a standard gross profit percentage. Here, obviously, we would use 34% for Home Depot. We're going to use 2 exercises to illustrate the gross profit method. Both of these exercises deal with inventory losses due to extraordinary events, fires, floods. In 9-8, the inventory was completely wiped out. In 9-9, parts of the inventory can be salvaged. So let's use these two examples to see how we're going to use the gross profit method. Here's our facts for exercise 9-8. In September we have a flood that destroys the entire merchandise on hand. We have the inventory from January 1, which is our beginning inventory. We have the net purchases and net sales and the gross profit ratio. Using these four pieces of information, we can estimate the ending inventory, and that would give us the loss that was sustained in the flood. So we have our beginning inventory from the company records, the net purchases from the company records, and the first thing we're going to determine is the cost of goods available for sale, and that is simply going to be the total of the beginning inventory and purchases. So we'll set up our formula. We'll get the equal sign to tell Excel we're dealing with a formula. We're going to reference cell B3, add in cell B4, and that will give us our cost of goods available for sale. Next, we're going to determine the cost of goods sold. Net sales for the period were $550,000. The gross profit margin for this company is 25%. To estimate the gross profit, we're going to take the sales, multiply it by 0.25, and that gives us our gross profit of $137,500. Our estimated cost of goods sold is sales minus our gross profit. Sales minus cost of goods sold gives us gross profit, so we can solve for the missing amount by applying simple algebra. So sales minus our estimated gross profit gives us an estimated cost of goods sold of $412,500. We had $510,000 available for sale. We estimate we sold $412,500, which means we have in our remaining inventory the goods available for sale minus the goods that we sold, and we can estimate that the loss due to the fire was $97,500. In exercise 9-9, the key difference is that after the fire, some goods were still salvageable, and we estimate that the value of those goods can be resold for $12,000. So we'll adjust the loss by the $12,000. In this problem, we also have a different gross profit percentage here. It's 35%. Other than that, it's the same procedure. We're going to take the beginning inventory, add in our net purchases, and that gives us goods available for sale at $240,000. Our sales for the period were $220,000. We're going to multiply that by a gross profit of 35%. So our estimated cost of goods sold is going to be the sales minus the gross profit, or $143,000. Our estimated inventory will be the goods available for sale minus the estimated cost of goods that were sold. So our estimated ending inventory was $97,000. Well, we're going to be able to recoup $12,000 from the sale of the damaged goods, meaning the value of inventory that was destroyed was the $97,000 minus the $12,000. So again, a very useful method in accounting that is frequently applied in both financial, managerial, auditing, and forensic accounting.